Well, hello everyone. Thanks for joining me today for a chat about the price to earnings ratio. I'll take a look at how it's calculated and why I think it's one measure that perhaps should be a part of your analysis when making your investment decisions. Now, that hasn't always been my view, and until recently, my former disregard for the PE ratio did not have a negative impact on my portfolio's performance. But since bond yields have been rising and we now see an upward trend in the Aussie cash rate, my portfolio has been significantly underperforming the returns of the overall market. In fact, a number of my patrons who still support me and my research have also found that their portfolios have come under pressure recently because of the way that Mr. Market is viewing the investment worthiness of stocks with a high price to earnings ratio. So for those who are new to the market, here's a brief overview of the PE ratio. It's calculated by dividing the current share price by the most recent reported 12 months earnings for the company. Let's use Johns Lyng Group as an example. When it released its interim financials to the market on February 22nd, its earnings for the 12 months to December 31st of 2021 were 9.17 cents per share. Now, on that day, its share price closed at $7.34, and so its PE ratio at that time was 734 cents divided by 9.17 cents, giving a ratio of almost 80. Its share price rose to a high of $9.37 on April 22, so at that time its PE ratio was 937 divided by 9.17, giving a ratio of 102. Now, stocks with a high PE ratio are considered by some investors to be very expensive and perhaps overpriced. In other words, the share price has risen too quickly, and so buying when the PE ratio is elevated could be risky. And it might be better, in fact, to wait until the share price falls to a level where it is perhaps more fairly valued. Now, there's no well-established and proven rule to determine whether a particular PE ratio is a critical value that we should wait for, as there are many examples of stocks that have always traded on very high PE multiples. And investors who have believed in the company and stuck with it through thick and thin have reaped the rewards of their faith on occasions. A company like WiseTech, for example, ticker code WTC, is a perfect example. Since it listed on the ASX, its PE ratio has been as high as around 200, but only as low as about 70. Many analysts have argued that it is far too expensive to be an investment-worthy stock, but since listing, it's returned a compound annual growth rate of more than 45% and currently trades on a PE ratio of about 95. Now, I used to be a member of the Team Invest group, and one of the metrics that they often focused on was the relationship between the current PE ratio and the historical range for it. Companies trading in the bottom third of that range would be considered worthy of further investigation. But even so, 95 is a very high PE ratio for WiseTech, even though it's in the bottom third of its PE range, when you're comparing that to the overall market average PE ratio of only 16. In the last 12 months, there's been a clearly defined trend of high PE stocks being sold off, with many investors reallocating their funds into stocks that are seen as having better value. In other words, Mr. Market is saying don't be in potentially overvalued stocks and concentrate on stocks with much lower PE ratios. There are some who would say that the PE ratio is a poor measure of whether a stock is undervalued or overvalued or is in fact trading at a fair price. And they prefer to apply techniques such as discounted cash flow to estimate the intrinsic value of companies. But that's way too much guesswork involved in that for my liking. But hey, Warren Buffett seems to do okay using his version of that approach, so that's something you might want to investigate. But there are trends that are very clearly apparent when the market is viewed over many years, and the most recent of those has been the sell-off of high PE stocks over the last year or so, to the point where the current market average PE is 11 less than it was at the end of 2020. In the greater scheme of things, that is massive, but to be fair, that PE ratio of 27 18 months ago was way higher than what it normally would be for the market. As you can see from the table on the screen, the market average PE ratio tends to remain below 20 most of the time. And even including those data points where the PE was elevated, the average since December 2013 is 18.5. And so right now, the market average PE ratio is just about as low as it's ever been. That's no proof, though, that now is the time to be pouring into the market, as it seems likely that interest rates will continue to rise for at least the next 12 months, and perhaps longer, until governments around the world are able to bring inflation under control. Could be some time, in fact, before that inflation rate returns to the preferred 2 to 3% level, and there really is no way of knowing how high interest rates will go. But I've been doing some research lately on the correlation between interest rates, PE ratios, and the performance of the stocks that have passed the filters of the strategies that I developed over the 3.25 years that I ran the Invest for the Future channel. You know, I'd love to be able to share the progress of those strategies with you, along with how I'm dealing with the current challenges that those strategies are facing. But I can't, and I hope you're well aware of my reasons for not being able to do that. I am partway though through that analysis, and there is clear evidence developing that I should have been paying much closer attention to interest rates and PE ratios. I've been sharing the results in general terms with the patrons who have remained subscribed to the Invest for the Future Patreon page. If you wish to view that research, then the link is in the video description. But just to wrap this up, many high PE stocks have been harshly treated by the market over the most recent period, but there really is no way of knowing whether the fall from grace is over, in my humble opinion. In the case, for example, of Johns Lyng Group, despite reconfirming that its business is growing as expected and that full year 2022 will be a record year for both revenue and earnings, its share price has fallen from $9.37 to $5.67 in just over a month. As a consequence, its PE ratio has fallen from 102 to a current value of 62. Given that its PE ratio was only 36 in the middle of 2020, it really could fall further. But that doesn't mean its share price will necessarily be falling. If it happens to report earnings of 15 cents per share as forecast by analysts when it releases its annual financial statements in August, and the share price remains at the current value of $5.67, its PE ratio in August will be 567 divided by 15, giving a ratio of 37.8. Just about the same as it was 2 years ago. Perhaps that means the share price for Johns Lyng Group has finally settled at a value that more accurately reflects its intrinsic value. Or perhaps not. I hope you found the discussion worthwhile, and as I mentioned, for more in-depth discussion, check out my Patreon content.